Hey, welcome back to a short week with Mortgage Minute. My name is Jeff Harrison. We'll have our expert and host on in just a moment. But, I got to thinking, July the 4th this year may have a significant meaning different from future or from past Independence Days because, it's like, hey, you have a holiday. You're supposed to have kind of a short week, kind of take it easy, kind of sift through, kind of drift through the rest of the week, call it a weekend and come back hard on Monday. But I'll tell you what, there's some things that have been happening that just won't seem to slow down. The good news is our economy seems to be going, gangbusters. The bad news is our economy seems to be going gangbusters. So with that, I'm going to bring on the expert and try to, kind of make sense of all this stuff because, I think of like Econ 101, supply and demand. And, I'm just a kid from West Texas. Like, let's keep it real simple. And that's why we're bringing Art in here because he's much smarter and better looking than I am. And he can figure this stuff out. Art, welcome.
I don't know about that, Jeff.
I won't even ask which part, but let's just dive into it.
Yeah.
So, July the 4th, there was a lot of fireworks, but the markets were closed on Tuesday, but they seemed to open up with a bang on Wednesday.
That is true. Yeah, we had sort of a short week on Monday, which is typical the day before a holiday. Of course, the market was closed on Tuesday. And, usually when you have that scenario, then overall it can be a quiet week, but that did not prove to be the case in particular today, which we'll get into when we start the show. So.
Hey, before I jump out of here, I just want to remind you, if you're joining us live, I'll be back in the background checking comments. And if you have a question for Art, maybe there's something specific that you need to know about, even if he's not talking about it today, we're going to give that question to Art and he will answer it live. Or if you're watching it afterwards and you didn't get a chance to put your question there, put it in there anyway, whether it's on YouTube or Facebook, and Art will circle back around and he'll answer that question for you because his slogan is, Art,
we have the answers and they're on the house.
And with that, I'm out of here. Have a great show.
Thanks, Jeff. Hello, everyone. Art Alvarez at Mortgage Works, where we do have the answers and they're on the house. Hope you all had a good 4th of July holiday. Turns out this week has had a little bit of a bang to it. So let's get right into it. As we usually do at the start of this program, want to give you a little update on rates. You might not consider this all that good news. Rates have trended up again this week. In particular, today, you can see our rate grid right here on the homepage of our website. We are now fully in the sixes throughout for conforming loans. Even, in fact, in jumbos, we're even now breaching the 7% level. So why is that? What's going on? Because it seemed like things were relatively stable, at least up until today. Well, if you look at the 5-day 10-year bond chart, it kind of gives you an idea of what's going on. Now, this chart actually is interesting because it shows a little bit of a settling because earlier this morning, the 10-year bond yield really shot up. I mean, the trajectory was like a skyrocket on the 4th of July. It really shot up. In fact, at one point this morning, mid-morning, it was 4.08. And as you all know, I talk about it all the time. I think the 10-year bond yield is a good barometer, probably your best benchmark to track where mortgage rates are going. So why the big increase today? Well, let's talk about that. There's a few things involved. And by the way, when I go over this data, what you're going to see yet again is an indication that the economy is a little bit schizophrenic. There's some mixed signals going on. So why is that? Let's talk about the details. Well, one thing that kind of spooked the markets today is, in fact, actually started yesterday, was the release of the Federal Open Market Committee minutes. That's the Fed minutes. Those got released yesterday. And what I found, and of course, to summarize those minutes, what it basically indicated is that the Fed believes, or basically declared, that there's going to be more rate hikes to come, although at a slower pace. Now, what's frustrating about that is that's not new news. If you remember last week's program, I had mentioned I had saw a quote from an economist years ago who had commented that the financial markets can sometimes react with reptilian-like minds to stimuli. And I think yesterday's release of the minutes was another example of that. These minutes simply reiterated what we already knew at the conclusion of the last Fed meeting, where Chairman Powell, at the conclusion of the 2 days of meetings, as they always do, he was interviewed by the press, and he essentially declared what the minutes corroborated, that the Fed believes that they have still more to go to fight inflation, that they're not done raising rates, although they did take a pause in June, and that there were more rates to come, rate increases to come, but at a slower pace. So again, a little odd that the market reacted disfavorably to that, to the minutes, because we already knew that information before they were released. Now, the other thing that has come out, and this was yesterday, was factory orders. Now, factory orders did rise by 0.3%. That's the fifth gain in 6 months. However, that's really not an indication that the economy is strengthening. The forecast for factory orders was supposed to be 0.8. So that was actually a disappointing number. And in reality, there is, I think, pretty widespread belief that that at least in the factory sector, in manufacturing, we do have a recession going on. So really, then, what else today triggered the increase in the 10-year bond yield? Well, it's all about jobs. In fact, this week was sometimes referred to as the jobs week because of the amount of jobs data to be released. Well, one of those data points is JOLTS, which is Job Opening Labor Turnover Survey. So it covers job openings, hires, and separations. Well, in the JOLTS report, it showed that the amount of jobs available had fallen from about 10.1 million in April to 9.8 million in May. So this is an indication of less job openings, implying that the employment market is still pretty strong. Now, the other information that was released today, as it relates to employment reports, was ADP. Now, ADP, as you may know, is a private company. They provide payroll processing for companies, and they do a survey of new jobs that have been opened or started. And their release of data today was a shocker. They indicated almost 500,000 new jobs. Actually, it was 497,000. That's in fact, it was double what was projected. The projection was that they were going to indicate about 235,000 new jobs. So that was a super hot number, really shook the markets, implying that the employment market is really very good. The other thing that came out today, though, again, cross signal, unemployment claims. They were actually up by not only 12,000 to 248,000, still below the peak that got hit earlier in the year of 265,000, but nonetheless, more claims for unemployment. So again, a cross signal. So the real key here is we've got conflicting data. And so in that regard, what we have to realize is that it's going to be a question of what the Fed's going to focus on. And right now it seems to be jobs. Now, I think a very key number will be tomorrow. Not because of ADP today, of course, their information, their report is taken seriously. But tomorrow, I think, is the better number, the key number, because then we're going to get employment numbers from the Labor Department. So that comes out tomorrow on Friday, and it'll be interesting to see how that affects the market. If it supports the ADP number, then that suggests to me that, yeah, the employment market is hot. That's probably not going to be good news for the bond markets, and we may not see much of a settling down in the bond yield. Although, again, by this afternoon, that 10-year bond yield, which had gotten to 4.08, it settled down to 4.03. So a little bit of improvement late in the day. One other point to make about the mortgage market and interest rates, with today's move in the 10-year bond yield, as well as the 2-year bond yield, that spread, that inverted yield curve I talked about last week, is now even larger. It's super wide. It's 1.25% in terms of how much higher the 2-year bond is over the 10-year. So that's a super spread, super inverted yield curve. And again, I've argued last week in our program that I think is the strongest indicator of whether or not a recession is coming. But again, there's a lag period to that, so we just don't know how soon that may occur. So there you are. That's where we're at with mortgage rates. We'll see what happens tomorrow. I will point out, too, don't panic. We've hit the 4% level in the 10-year bond yield a couple of times this year and then settled back down. I wouldn't be surprised if we see that again. So keep that in mind. Now, let's move on to another subject. As you know, I always talk about beware the headlines. And so I'm always going through the financial news to look at headlines and see what's going on there. And something caught my attention this week that I wanted to talk a little bit about. It was a report by CBS News, and the title of the article was, "What if mortgage interest rates stay high?" here's what experts say buyers should do. And of course, that caught my attention because I'm always curious what the so-called experts think should be done. In this case, what buyers should do if mortgage rates are going to continue to stay high. And this article touched on several key points that I want to go over right here, right now. And here they are. One was buy now, refinance later. You've heard me talk about that before. I've been saying that for months. I really do think that either buyers who don't own a home now, or maybe homeowners who own a home who want to buy another home, they really should act now. Don't wait for rates to fall. Don't wait for property values to fall. I think they should buy now. So you've already heard me talk about that. The next point was that the article made was make a larger down payment. The next one was consider different loan options. And then the next one was stay put and improve our home instead. Well, you've heard me talk about that quite a bit. In fact, last week I brought that up again, that equity lending, I think, is a good option for homeowners who are locked into that very low first mortgage rate. Another idea was buy down your rate. I've touched on that before, but this article took that subject at a different angle, which I'm going to comment on in a minute. And then the last point this article made that these experts suggest was, well, just wait for rates to drop. So the few of these caught my attention. So I want to delve into a couple of these in a little bit more detail. And in that regard, the first one, and this is what was kind of the lead point in the article, was make a larger down payment. Well, when I saw that, I kind of chuckled a little bit for a few reasons. Now, it did point out if you make a larger down payment, for example, if you get at least to a 20%, it's going to eliminate your mortgage insurance. That can be a significant cost. So yeah, I agree with that expert. Doing a larger down payment is going to eliminate mortgage insurance. The second point the article made about this particular subject about down payment was it's going to lower your rate. Well, yes, but, and I say yes, but because that's not entirely true. Here, what do I mean by that? Well, there's this belief that if you put less than 20% down, you're going to have a higher rate than if you put 20% down or more. That's not really actually true. And why is that? Well, it has to do with those loan level price adjustments that made, the news here a few months ago, when there was that change that occurred where people with higher scores were going to supposedly pay more than people with lower credit scores. Well, that is not what is at issue here. So what do I mean by lower interest rate does not necessarily, a larger down payment does not necessarily lower your does not necessarily lower your interest rate. Well, what I mean by that is there's a particular loan to value segment where you're going to pay more. And again, the belief is it's 80% down, 80% loan, 20% down, you're going to get a better rate. Not true. If you look at the loan level price adjustment grid from Fannie Mae, you're going to actually see the highest pricing for mortgage between a loan to value of 75.01 up to 85%. If you go up to over 85%, you're generally going to get better pricing. And if you're at 75% loan to value, meaning 25% down payment, you're also going to get better pricing. So that 75.01 to 85% loan to value. So in other words, about 15 to 20% down, that particular threshold, that's where you're going to have the highest pricing for the mortgage. And most folks don't realize that. So I think that's an important point for you to know. Now, the other thing about a large down payment, and I have this discussion with borrowers quite often, is the fact that a larger down payment is not very effective in lowering your monthly payment. What do I mean by that? Well, at current interest rates, every $1,000 less borrowed is only going to reduce your monthly payment by $6. So if you do the math, if you put $50,000 extra down, a borrower is generally going to be disappointed when they find that much larger down payment is only going to reduce your monthly payment by about $300. So again, though this expert's suggesting, just put more money down, you're going to get, a much better rate. That's not entirely true. And in terms of monthly payment, it's not going to reduce your monthly payment substantially. Again, $6 per thousand is a good rule of thumb to keep in mind in terms of the relationship between more down payment and what your resulting monthly payment is going to be. So in that regard, the other thing about this making a larger down payment I find interesting is it's easier said than done. What I encounter more than anything else, and I would say most mortgage originators would agree with me, the biggest obstacle for home buyers is that down payment and coming up with enough down payment or believing that they need more down payment than they really need. And in fact, sort of another article that caught my attention, this is from it's called Go Banking Rates. They actually had an article that suggested that for most people, it will take them more than 15 years to save for the down payment. And it named 6 specific cities where that's the case. And guess what? 5 of the 6 were in California, places like LA, San Francisco, San Jose. The only out of California city was Honolulu. And the article was pointing out that if you assume that a household saved 5% of their income per month, that they would say that would take them 15 years to accumulate a 10% down payment. If they saved 10% of their income monthly, it would still take them 15 years to save up enough for a 20% down payment. Now, part of my argument with that article is that it's perpetuating the belief that you have to have a 10 to 20% down payment to buy a home. In a lot of cases, that's simply not true. As I pointed out before, you can get a loan in many cases, particularly if you're a first-time home buyer, with as little as 3% down and even 3.5% to 5% down. So just understand that you don't need to save 10 to 20% down payment to buy a home. You can get a home with a lesser down payment. Now, of course, you have to have enough income to qualify on the monthly payment, but that is doable, and that's something I think prospective home buyers need to be reminded of. Now, the other point in the article that I had a little bit of an issue with was the idea of choosing a different loan option. And in that regard, the article was specifically discussing ARM loans, again, adjustable rate mortgages, because they offer a lower rate and lower payment for the first few years. That is true in most cases. Now, the typical ARM loans these days are ones that are what we call hybrids or fixed ARMs, where the initial rate and payment are fixed for 5 years or 7 years or 10 years. Now, there's a reason that the industry has come up with that, and that is the average length or life of a mortgage in the U.S. Believe it or not, the average mortgage length in the U.S. is less than 10 years. And I want you to understand that because in a lot of cases, I'll encounter a prospective home buyer or even a homeowner who's looking to refi, and they'll do their analysis to compare how much interest they're going to save over a 30-year term. Like, for example, comparing a fixed rate to an ARM loan that might have a lower rate. Well, I think that's a little bit of a faulty analysis because in reality, most homeowners are not going to keep that mortgage for that long a period of time, certainly not for 30 years. The probabilities just aren't there. Again, the average mortgage length is less than 10 years. So you got to keep that in mind. The other thing about ARM loans, when it comes to conforming loans, that is loans that are sold to Fannie Mae and Freddie Mac, ARM loans are not priced well. You are not going to be happy with the rate you can get for a Fannie Mae 5-year, 7-year, 10-year ARM. They're just not priced well. In fact, in most cases, the rates on those are worse than a 30-year fixed. Where you are going to potentially see some benefit in an ARM loan having a lower rate is going to be depending on who the lender is. Some credit unions will offer ARM loans, again, these hybrid ARMs, with some attractive rates that are below fixed rate levels, 30-year fixed rate levels. And then some banks, particularly the big banks, particularly those who are serving the high net worth, high income individuals, can have some pretty aggressively priced hybrid ARMs, although that usually involves a trade-off where they'll provide a better rate to that high income, high asset, high net worth borrower. They'll give them a better rate if they put a substantial amount of money in the bank. And so in that regard, the amount of ARM loans being made even right now with mortgage rates quite a bit higher, double what they were a couple of years ago, is still only 10% of the market. So again, despite the fact we have much higher 30-year fixed rates right now, ARM loans really are a very small percentage of the market still. Now, the other thing about on this particular point that the article made was change your loan term. Get a 15-year loan. Well, that makes me chuckle too because there's a trade-off there. And I run into this all the time. I can't tell you how many times I've had a prospective borrower ask me about, I want to look at a 15-year loan because I'm going to get a better rate, which is true. And I'm going to save interest on the loan, which is also true. But here's the kicker. A 15-year loan is going to offer a payment that's going to be generally about 30% higher than a 30-year fixed. And when I provide that information to a borrower, I would tell you 90% of the time they say, oh, didn't realize that, never mind. I can't tolerate that high of a payment every month, which of course, in that regard, I always tell them, okay, take the 30-year fixed. If you want to pay it off sooner, go ahead and add extra principal to your payment, and you can accomplish the same thing. You lose that interest rate break with the 15-year term, but you can still accomplish some, acceleration in your principal pay down. And as a result, 15-year loans are still a very small percentage of the market, only about 9% of the market. And one other tip, if you are thinking about a shorter term loan to try to save on interest or interest rate, consider a 20-year term. That's not well known. I always bring that up, offer it quite often. It's a pretty good compromise between a 30-year fixed and a 15-year fixed where you just can't tolerate the payment. A 20-year loan can be a pretty good option. So another idea that the article pointed out as to what you should do in a high interest rate market was to buy down your rate. Well, you've heard me talk about buy downs for quite a while now. I'm getting to be a broken record about that, right? Yes, but in this particular article, what the writer was suggesting was for the borrower to buy down the rate, which I question that, because the challenge with doing that is if you're going to spend your own money to pay a point or two to buy down your rate, you're creating a scenario where you're going to take several years of that lower rate in payment before you're going to recapture that upfront money that you're going to be paying. And as we pointed out earlier, the average length of a mortgage is less than 10 years. And so in some cases, you may never recover that upfront cost. And just the basic concept of time value of money, I'm not sure it makes financial sense to pay more money up just to subsidize your rate for over the term of the loan if you're not going to keep that loan long enough to actually achieve that benefit. So again, is it very common for buyers to pay points? No. I mean, frankly, I can't remember the last time I had a buyer purchasing a home, and certainly on a refi, a borrower or a homeowner pay points to lower the rate. That just doesn't happen very often. So in that regard, a buy down is a good idea. I don't agree that it's a good idea for the borrower to pay the buy down cost. I still think you're better off have the seller pay the buy down, as we've talked before. And there's even lenders who will offer what's called a lender funded buy down, like a 3-2-1 or a 2-1, where they raise the note rate to create enough premium value to provide you that 2-1 or 3-2-1 rate schedule and payment schedule. But at this point, those are not priced very well, and they're really not a good, effective alternative to just negotiating on a purchase to get the seller to pay the cost of the buy down for you. So I felt that particular suggestion was a little bit weak at best. And then the last thing that the article suggested was wait for rates to drop. Well, that could be a while. Fannie Mae, for example, is projecting rates to end the year at 6.3. The Mortgage Bankers Association is projecting rates to end the year at 5.8. Not much of an improvement over where we're at now. So waiting for rates to drop could take a while. And as you may know, and I've pointed out before, I'm becoming a little bit of a broken record on this. Once rates do start to fall, that's going to bring more buyers into the market. But more buyers into the market is going to support the home prices because we have an extreme lack of inventory in most parts of the country, usually about 2 months supply. So even with lower rates, that increase in buyers, that increase in pent-up demand is going to bring inventories back to normal levels, but just bringing them back to normal levels isn't going to allow for home prices to moderate. In fact, home prices are probably going to go up at that point. And another data point to support that argument, Fannie Mae just recently revised their forecast for what amount of decline in home prices will occur this year. And they're forecasting for 2023, it's only going to be 1.2%. Earlier in the year, they were forecasting 4.3% decline. So we already have pretty strong evidence that home prices are already firming, and in some markets have already started increasing from earlier this year. So again, I felt that this particular suggestion from the expert was, again, weak at best. So just keep that in mind. I'm going to continue to say, even today, with today's increase in the bond yields and mortgage rates, if you're contemplating purchasing a home, I think you're better off. Look to buy now, even with today's current level of rates. Use strategies to try to subsidize that rate and get into home ownership sooner than later so you can take advantage when those home prices start to go up as rates fall and more buyers enter the market. So that's that with that particular article. Now, I want to kind of change gears here and talk about a loan product, particularly as it relates to retirement mortgage. Now, you all know about reverse mortgages, or I think most of you do, I'm sure. But you know what? Not every person, not every homeowner who wants a reverse mortgage is able to get one. So I wanted to introduce to you another alternative to reverse mortgage that's pretty interesting. It's called equity avail, and it's pretty revolutionary. And what this involves is it's a program for homeowners who want a reverse mortgage but are unable to because they don't have the cash to contribute to the transaction. In other words, the reverse mortgage amount they can get is not sufficient maybe to pay off their existing loan or to get the amount of cash that they need. In other words, they have to contribute cash to close the transaction. And this program is a little bit unique in that it's homeowners near or in retirement. Well, what do I mean by near? Well, one benefit of this is that you only have to be 55 years old to be eligible, not the usual 62 for a reverse mortgage. So that gives an opportunity for someone who's nearing retirement to get a reverse mortgage-like product without actually being 62 years of age, because this equity avail is essentially it's kind of a reverse mortgage hybrid. So what are the criteria to be eligible for this product? Well, again, you have to be 55 years or older. All borrowers have to be that age or older. You do have to have an existing mortgage with at least 10 years remaining. And with this program, what you'll do is you'll make partial interest-only payments for the first 10-year period. The purpose of the interest-only payments is to help defer the negative amortization that would otherwise occur by not making any payments at all, which is how a reverse mortgage would normally work. This loan actually provides loans for a minimum of $100,000 up to a maximum of $4 million. So even those multi-million-dollar properties, the owners of those properties, if you're near retirement, 55 plus, this could be a good option for you. Now, unlike a standard reverse mortgage, you do have to have some minimum credit score, in this case, 680. The other thing is you do have to meet a debt to income ratio. The standard is 43%. However, if you don't meet that debt ratio of 43%, you can still be eligible for the loan using a residual income approach. And what's really neat is residual income is based on the loan amount size, not the number of individuals in your family. So that's a little bit more flexible residual income target to meet. And quite often, for a homeowner who doesn't meet the debt ratio requirement, this residual income alternative is the way to make it work. And what happens after 10 years? After 10 years, you don't make payments anymore unless you want to. Again, just like a reverse mortgage. Again, remember, reverse mortgages, you don't have to make a monthly payment unless you want to. Most folks don't realize that. Same with this. After 10 years, you no longer have to make a mortgage payment, but you can if you want. And then the only other thing you have to keep aware of is you do have to maintain your insurance and taxes, your property insurance, your property taxes. In fact, when this loan is set up, you actually have an impound account, also known as an escrow account, to pay your property taxes and your insurance, just like your existing first mortgage probably requires. So that's the only thing you have to maintain even after that 10-year period, when you don't have to make payments anymore, again, unless you want to. So this is a great alternative for someone who's either nearing 62 but not there yet, or they are 62 or older, but maybe their loan balance on their current home is too high so that the reverse mortgage doesn't give them the benefit to get rid of that first mortgage without contributing a large amount of cash to make that happen. And what a lot of folks don't realize is over 1 million homeowners who are over 60 years old have a first mortgage on their home. In fact, about 50% of homeowners in that age group have a first mortgage that they'll never live long enough to see them paying it off. So this is a good way to reduce your monthly payment, create some liquidity, even if you're not at that 62 years of age for a reverse mortgage, or if you don't have enough cash liquidity to contribute to getting rid of your existing first mortgage to enjoy that period or that lifetime of no monthly payments. So if you have any interest in this, if you know anybody who's tried to get a reverse mortgage and was unable to, or maybe you yourself have tried and were turned down because your first mortgage balance was too high, get in touch with us. We'd love to give you some numbers. This could be a great option for you. Okay, with that, let's go ahead and get into our closing question from last week, which is, What is a DSCR loan? Well, DSCR stands for Debt Service Coverage Ratio. Now, this is a specialized program. It's part of the non-QM, the non-qualified mortgage basket of loan programs. It's a loan program created specifically for real estate investors, people who are investing in residential real estate. Now, what is the DSCR ratio? Well, it is a calculation where we take the gross income that the property is going to generate divided by the PITIA, principal, interest, taxes, insurance, and association dues, if applicable. That's it. If that ratio is 1 or greater, meaning it's a break even, this loan is available. Now, there's even lenders who will make this loan even if that ratio is below 1, meaning it's going to create negative cash flow from the outset. You can still get this kind of loan. The benefit of this, like I said, it's a low doc loan for real estate investors, people who are investing in residential rental real estate. The benefit, of course, is low income documentation, no pay stubs, no W-2s, no tax returns. You're not qualified that way. So this is kind of a streamlined way to get qualified without all that, extensive documentation to meet a debt ratio. It's available on 1 to 4 unit properties. Condos are okay, including non-warrantable. What does non-warrantable mean? That's usually a condo where there's short-term rental allowed, where conforming loans usually won't touch that kind of property because short-term rental is prohibited for conforming loans. So this is a great program for that kind of scenario. You can still get a maximum loan to value of 85%, so you only need 15% for a down payment, or if you're doing a refi, if you need cash out where you already own existing residential rental real estate, you can get cash out up to 75% of the property value. And if you have a lot of residential rental real estate, there's no limit on how many that you have. Many conforming loans will have a limit of 4 to 10 properties that you can have that are owned and financed, be able to get financing. With this type of loan, there's no limit. And this loan, I think, works very well for residential rental property that is short-term rental type of a property. Now, I talked last week about in some parts of the country, short-term rentals are suffering from a lack of adequate revenue, but in some markets, particularly mine here in the Palm Springs area, short-term rental properties are still very strong, and the income that's being achieved is quite high. So with this kind of loan, short-term rental income is okay, and in fact is really probably the best scenario to use this type of loan, either to buy more short-term rental property or to refinance the ones that you already have. So again, if you're interested in residential real estate, residential rental real estate, great program to look at. And for you homeowners who are stuck, you can't sell because you have a low first-rate mortgage, consider this program. Get into getting some residential rental real estate. I can arrange a HELOC or a fixed rate second for you. That can be your down payment to buy one of these rental properties, and then you use this program for a low doc approach. Now, again, a little bit higher rate, a little bit higher on the fee side, but hey, if the program is going to verify that you're going to have a positive cash flow, even with those higher rates, it's a program you've got to consider. It can be very effective in building a portfolio of residential rental property. So keep that in mind. Give us a call if you want to get more information. And with that, we're going to go ahead and close the program with our closing question for next week. And this is actually something that I decided to add because it came up over the weekend. We're talking to some friends who live in Orange County. They're high income people, but they're renting. And they were kind of groaning about the lack of down payment that they felt they needed to buy a home. So with that in mind, here's the question that we'll talk about next week. Consider a married couple who are renters with high employment income, and they have their eye on a home that's for sale for $1,125,000, but they only have $70,000 available for a home purchase. Are there any loan programs available for them to buy without saving a significant amount of money, a significant amount of additional funds for the down payment? So contemplate that. I think you're going to be interested in the answer. I think you'll be surprised by the answer, actually. So tune in for next week, where I will have an answer to this question, and it will be on the house. Jeff, back to you.
Hey, Art. I guess that was there was some good news in there. I think it's one of those things about people that if you are on the fence, it's time to make a decision and move forward and use some of the things you're talking about. I love this last piece that you talked about, the DSCR.
Yep.
And for those people who have a lot of equity in their current home, is to go to you, get a HELOC, and use that as your down payment on a rental income property. That's what a great idea. What a great way to do, to unlock some of that equity in your home. So even if you're not even thinking about moving, but you're thinking, hey, is now a good time to buy rental income property because of some of the short-term rentals and things like that? Hey, why not? That's a great idea. Make sure to give Art our call. You see his number here on the screen, 760-883-5700. That's his office. Of course, there's always the red hotline number, 714-612-9035. That actually, if you ring that number, you'll see it flash in the sky. No, it's not Batman. That is Art Alvarez. He's answering that line, 714-612-9035. Always go to the website, check out the rates of what's going on, and you can always send Art an email at art@mwloan.com. Remember, if you're joining us after the program has already aired and you have a question about things that Art has talked about, just put the comments in the question or your questions in the comments, and Art will get back to them. Art, I think the old saying of supply and demand is really working here. It almost feels like we've had so much rain here on the West Coast and the snow melt and that kind of stuff. The dams are full. What is it going to take to get people to release some of that pressure? What do you think is going to have to happen?
Well, I mean, I do think that we're going to have to see some improvement in rates. Again, I've talked before about how in the resale markets, while we talk a lot about, the strategies to subsidize interest rates so that homeowners who want to sell their current home and buy a bigger, nicer home can pursue that strategy to try to buy now. While we talk about it a lot, I think there's still some, a lot of those homeowners are hesitant to do so. I think there's a little bit of fear involved. And so in that regard, I do think we probably do need to see some rate moderation in the relatively near future. In fact, I was talking to a real estate agent earlier today at a meeting where she commented that she feels that we need to see rates back in the fives to really loosen things up and get some of these homeowners off the fence to sell, as well as get some home buyers off the fence who are, I think, now kind of settling in on the idea rates are where they're at. And so if we can at least get a little bit of improvement, like in the fives, that might really loosen things up. Of course, I pointed out to her when she told me that we were in the fives earlier this year. But at that point, I don't think people were convinced that was going to be attractive to pursue at that time. I think they were waiting for below 5. Well, now I think some of those folks probably, when they're seeing we're now close to 7, are probably kicking themselves, and they should have jumped on it back in February, March, April, when we were in the 5s. So if we get back to that, I think things are going to loosen up pretty good.
It reminds me of how we can get comfortable in things like, we just had a spell here in the Coachella Valley where it was like, 114, 115, 116, and it was hot, right? Yesterday was like 107, 106, and I was outside going, hey, it feels pretty good.
Yeah.
That almost feels like this, hey, I don't want to pay 6.875 for a rate, but if it's 5.5, I'm in.
Yeah.
Is that kind of what's going on?
I think exactly right. And again, I think when we were at that level in those 5s, mid 5s to high 5s earlier this year, I think at that point, people just weren't convinced that maybe that's as good as it's going to get for a while and they should grab it. I think they were kind of, hoping for hope, holding on to hope that, oh, okay, it's getting better. We're in the 5s. Now we just need to get to 4 and 7/8 and I'm in. Yeah. And I think in hindsight, that was maybe not the best decision.
Yeah, they always say it's hard to time the market, isn't it?
Yep. It sure is. I always say, don't try to time the market. You'll drive yourself crazy.
Geez, I had a call today with a real estate agent down in San Diego, and we were chatting, and she was talking about the home. She's out prospecting for new home buyers and people who want to sell their homes. And she said, I realize, the home I live in is not my forever home. She said, I'm looking to go up. And I guess I should ask, what would be those trigger points? And you said, hey, it's the rate. When we see a little bit of an ease in rate could be the thing, because I don't think we're going to see too much of an ease in pricing based on what you showed us today.
No. All the forecasts on the home price front are pretty aggressive in that home prices aren't going to fall much, and they're probably going to go up, a fairly good amount in the relatively near future. So those waiting for lower rates, I wouldn't wait too long, because that lower rate, maybe even under 6%, may be offset or pretty much overwhelmed by the fact that the price of the home may be 10% higher than what they're looking at now.
Yeah. Hey, I want to kind of wrap this up with a dose of reality, because I know you've been doing this for over 4 decades. We're talking about rates in the sixes. How uncommon is this? I mean, we forget that, maybe a few years ago, 6 was a smoking deal, right? What is that? How is that in terms of what normal really looks like in your world over the last 4 decades?
Well, over the last, say, 10 years, 15 years, other than 20 and 21, I think the lowest point we got was about 9 or 10 years ago. We got sort of in the mid threes.
Mm.
And I've said before, anyone can Google the, U.S. mortgage rate history. And in most cases, what you're going to find is a chart that starts somewhere around 1971 to present. And what you're going to find is, other than that real big, run up in 1980, 81, 82, when we got up, 18, 17%, like 17 when I got in the business, throw that out, throw 20 and 21 out, what you're going to find is, in a lot of those years, we were somewhere in the 4 to 6 to 7 range.
Mm.
So I would argue that, right now maybe we're kind of getting up on the upper level of the normal range, approaching 7. But other than that, I mean, 4 to 6, 4 to 6.5, 4 to 7 has really been sort of the norm for most of the last 50 years.
Yeah.
But there's this kind of unreasonable time horizon where a lot of folks think that 20 and 21 were normal. And I said many, many times that was not normal. That was once in a lifetime. I don't think we're going to see it again anytime soon.
Well, with that being said, make sure you jot down the phone number. 760-883-5700 is the office number. Look for that signal in the sky, 714-612-9035. That is Art Batman Alvarez. He's going to help you secure either, hey, a HELOC to start investing in, rental income property, or maybe even take a look at that other program. What was that again? This is for near retirement, and 55 is your age. What did you call that again?
Yeah, it's called Equity Avail, and it's a hybrid reverse mortgage product developed specifically for someone who is either in retirement, over 62, who tried to get a reverse mortgage and was unable to, in most cases because they didn't have the cash to cover the shortfall to pay off their existing mortgage, or they're not quite 62 yet, but they'd like to get in place a reverse mortgage-like product where they can substantially reduce their existing mortgage payment for the next 10 years. And then after that 10-year period, have an opportunity to not have to make payments at all anymore for the duration. So.
Well, this is that opportunity when you say, hey, if you're going out looking for bronze coins, you're going to find bronze coins. But when you show up at this show, he has gold coins. There are opportunities out there for those people looking to refinance, those people who are looking to say, hey, I want to get into rental property, or should I buy right now? Yeah. Now is really the answer. So make sure to reach out to Art. Art, thank you again so much for being such a wealth of information and helping those people understand, from a true perspective of what are my options. You really laid those out today. I really appreciate it.
Sure. Thank you, Jeff. Appreciate it too. Thank you everyone for watching. And just remember, at Mortgage Works, we do have the answers and they're on the house. Take care.